So, are you a caregiver for someone else? More and more Americans find themselves in this position. According to the National Alliance for Caregiving, about 29% of the population falls into this particular category of adults. 1 in 3, if you're running the numbers on that. And I know we've been talking a little bit about this, or a little bit more about this, over the course of probably the past 12 months on this program. But the more we get into this topic, and the more that we have conversations in the office with folks that are dealing with this front and center, and the more, frankly, that particular topic has come home to roost personally with me. I am the primary caregiver for my mother. The reality is that we find various pitfalls that we think it is important to discuss with you on the program to help you navigate what can only be described as a very difficult and emotional process. So we're going to give you some of those sort of unique legal issues that you might encounter when providing care for a loved one, and what you need to know to help with that whole process. In addition, according to a recent USA Today article, more and more companies want you to keep your 401k with them after you leave. So the question is, should you do that? Well, we're going to give you a number of things to consider on that front as well, all of which will transpire on this week's edition of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast on the big wide world web. Make sure you check us out on your favorite podcast channel, or even our YouTube channel as well, where you get to see me sitting here in the Nelson Financial Planning Radio studio right at our office. And you can see how much I talk with my hands when you look at the YouTube video of this program. Any trouble finding our channel on any of those platforms, go to our website at nelsonfinancialplanning.com. There's going to be a bunch of icons there. Click on the one that is most familiar to you, and then you will get automatically connected. Once you're there, as you know, make sure you hit that subscribe button, because then you won't have to go through that process again. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries that stand ready, willing, and more than capable to help you improve your life with a successful and cost-effective financial plan. So a couple of weeks ago, we updated you on the inflationary changes to the income tax brackets. That's something that happens every year, regardless of what they do in Congress or don't do in Congress. But every year, the IRS puts inflationary increases onto the various tax brackets. Again, if you missed it, check out our podcasts on your favorite podcast platform. We mentioned in that show that we would be also, as soon as it was announced, letting you know what the 2025 retirement plan dollar limits would be, because at the time that they announced the inflationary adjustments for the income tax brackets, they said, well, give us another week or two and we'll have that work done for the retirement plan dollar limits. And so lo and behold, true to their word, they announced those as well just this past week. So for 401ks, 403bs, 457s, those types of qualified employer plans, the annual contribution limit increased from $23,000, which is the number for 2024. For 2025, it'll be $23,500. So the reason that that's important to you is that if you're putting in a certain amount per paycheck, and you're using that to ultimately get to that maximum limit, well, then you need to adjust that amount, because the amount that you can contribute is higher for 2025 than it was for 2024. Also, of course, if you're over 50, you can do an extra 7,500 catch-up contribution. That number did not change for 2025, but what is different for 2025 is if you are age 60, 61, 62, or 63, we talked about this last week on the program, then there's a special catch-up contribution limit that applies to you. And last week we talked about it being 10,000. That was the number prior to the inflationary adjustments that the IRS did. So in fact, based on the announcement from the IRS, the catch-up contribution, if you are in that 60, 61, 62, 63 age for 2025, is actually going to be $11,250. So pretty decent amount of extra dollars that you can contribute. Again, that extra contribution amount starts next year if you're in that 60 to 63 age group. The maximum annual contribution to defined contribution plans also increased to $70,000 from $69,000. Also, they announced the change to the retirement savings tax credit income brackets. Now, if you're not familiar with this particular tax credit, it is a very valuable one, particularly for lower income individuals that might be younger, might be just starting out on their work journey. And so the point of this particular tax credit is to encourage people to try and save money for retirement by giving them a pretty valuable tax credit on their tax return. So this is so crucial. We love to talk with clients and sort of recommend this course of action for their kids or their grandkids that are working, because when you do that, in essence, this tax credit, because it is a tax credit, it effectively works as literally free money from the government, although there's no such thing as free money from the government because somewhere they've got to collect it through taxes. But you know how that works, right? So this tax credit is a significant boost in terms of encouraging people to ultimately wind up saving for retirement, particularly if they find themselves sort of just starting out in kind of those lower tax brackets. So the credit itself it can be up to 50% of the contributions with a maximum credit of $1,000. So if you put $2,000 in and you're eligible from a income bracket perspective, well then, my goodness, you're going to get $1,000 of a tax credit. So that's pretty valuable. If you're married, you can get that tax credit up to $2,000. And any type of contributions to whatever retirement account that you've got available to you will count towards this credit. So whether it's a Roth contribution, a 401k contribution, a 403b, that's going to allow you to qualify for this particular credit. So a really powerful tax credit. It is income dependent, right? So you got to have below a certain income level in order to qualify for this credit. So in the IRS's announcement, they adjusted for inflation those income levels that you would need to stay below in order to qualify for that credit. So if you're married, if it's a married joint return, income's got to be less than $79,000. On a single basis, it's got to be income's got to be less than $39,500. So those are the income eligibility limits that now apply to that retirement savings contribution credit. We encourage you to really check that out, and certainly something that you may want to talk to your kids or grandkids about as well, because that would be kind of the group that might be eligible, right? I'm thinking of my son who's working. He's got a full-time job, but he's not making a whole lot of money. This would be the kind of thing where, because he does fund a Roth, then he would certainly be able to ultimately potentially pick up this retirement savings credit. So pretty good stuff across the board. In other news at the office, as you know, we are our annual toy and food drive is going on. So if you're interested in making a donation to Toys for Tots or donating food for Second Harvest Food Bank, make sure you swing by the office during normal hours. And we are collecting, as we have for many years now, collecting for those two worthy causes. With that, we're going to take a break and continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So if you find yourself in that caregiving role for a loved one, no doubt you're just juggling so much, whether it's medical appointments, whether it's emotional support. I mean, it's just it becomes almost a full-time job in and of its own right. And as we mentioned earlier in the program, according to the National Alliance for Caregiving, it's estimated that almost 1 in 3 Americans find themselves in that position. So on this segment of Dollars and Cents, we're going to go over some of the five of the key considerations or steps that you can do to sort of protect yourself and the person that you are taking care of. These concepts comes courtesy of an article that we saw in AARP magazine. Yes, I am of the age where I get AARP magazine. We'll leave it at that. But that certainly makes for a very valuable topic that we wanted to share with you, our valuable and faithful listening audience here on Dollars and Cents. So welcome on into the program where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. Make sure you check out our website, Nelson Financial Planning, to find how you can connect to us on your favorite platform of choice. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we've got a team of certified financial fiduciaries who stand ready to help you improve your life with a successful and cost-effective financial plan. While you're visiting the website at nelsonfinancialplanning.com, or if you want to just call the office at 407-629-6477, make sure you take advantage of our free holiday offer. Once again, this year we are giving out free hard copies, which we're holding up for the YouTube audience right now, of our book, Next Gen Dollars and Cents. To get your absolutely free copy, just give us a call or go to the website and talk about a great gift, right? The gift of being able to achieve financial success. Maybe there's someone in your life that could really use this book to help them get started, or maybe they've been relatively successful financially, but they don't really know everything there is to know about the different types of investments or about taxes or about retirement. Well, hey, this book, it's got it all. And as we said, and we've said before, we wrote the book. AI did not write the book. So make sure you check out that book when you visit our website. Again, giving out free copies as a little holiday gift from us to you in the hopes that you will then pass it on or pass it forward. So there's a variety of things that you need to be thinking about as a caregiver. And if you're a regular listener to the audience, you know that this is a topic that has become a little bit more near and dear to my heart, particularly over the past 12 months. And we've certainly featured it in terms of the topics on the program, probably a little bit more over the course of the past 12 months, mainly because we see it more and more. And we're dealing with it personally. So since it's our show, we get to talk about stuff that affects us personally. So, but it affects a lot of you personally as well. So as a caregiver, what are some of the things that you can do to really help yourself and your loved one to be in the best possible shape for the duties and demands that come as a result of being a caregiver? And it really does start with, you've got to make sure that the legal documents are in order, right? That in order to act on or operate on behalf of somebody else, there has to be a legal document that allows you to do that. You can't just say, hey, I am making decisions on behalf of my mother. No, they're going to want to see a legal document that helps to ensure that you, in fact, are the person that is able to make those decisions. So just be aware that paperwork on this one is important in order to demonstrate that you do have the permission to act on behalf of somebody else. The most common of those is a power of attorney. And so when you think about a power of attorney, that is the document that gives you the ability to act on someone's behalf while they are still living. Typically, that involves financial matters and things like that when they can no longer handle their own finances. There's a couple of differences between powers of attorney. There's this concept known as springing versus durable. And so it's important to know which type of power of attorney you have. If it's a springing one, that means that it's only going to take effect upon the existence or the proving of certain events, i.e., this person does not have mental capacity. Usually that's as a result of a physician's determination. That's a springing one where there's that extra step in order to ultimately act under that document. A durable one, you don't have to do that. You don't have to go through that process. It is available to be used instantaneously. So that's probably chief of, in terms of importance, that's probably the most important one. Followed closely by a healthcare proxy or a healthcare surrogate or a healthcare power of attorney. That type of document is geared specifically to health-related decisions. So the usual power of attorney deals with financial. The healthcare surrogate or the healthcare power of attorney deals with healthcare issues, and those are usually separate. Those are usually two different types of legal documents. Those documents all operate while somebody is still living. Once they die, then the powers granted in those documents end as well. And then the next two documents would take over, and that would be a will or a trust. Those would be the types of documents that would come into play, where now it's about dispersing the proceeds of the assets of that particular person's estate. One other document to throw in there, living will, that's sort of the terminal one where the living will sort of a part of that advanced directive type of concept as well. But those are the financial documents that you need to make sure that you've really got a handle on those, that you understand how they work and how when they are ultimately effective. So that's sort of step one. Step two is just sort of more of a logistics one. Make sure that you have the ability to protect and connect with your loved one's finances. So that's the whole concept of, well, if you're going to manage somebody's finances, then you kind of need to know what's going on with those finances. So, of course, these days, everything's sort of done online, so make sure that you have the ability to connect to those financial accounts. Make sure you've got access to those digital accounts. Maybe that means figuring out how you can log in on behalf of your loved one. That might involve also signing up for email or text notifications so you know if there's weird withdrawals or those kinds of things, especially in today's world, right? So many scams sort of target our seniors in a variety of ways. So if you're getting these text alerts or if you're getting these email alerts, you really may help to be able to prevent those types of scams from happening, because if you see chunks of money going out of the account that really shouldn't be, then that gives you an insight into what might be happening. So make sure you take advantage of kind of those emails and text exchanges, particularly when it involves a loved one's accounts that you are responsible for taking care of. Make sure that there's trusted contact information on file with the various financial institutions. I know when folks come into the office, we kind of are constantly encouraging them to fill out what is known as a trusted contact form. And that's just someone, it's not necessarily a power of attorney, it's just somebody that gives a name and number for the institution to be able to call if something smells weird or looks weird. So that's a good document to have in place. Just in terms of making life simple, to consolidate bank accounts, one of the biggest things that I did was I put a lot of things on auto pay. Most people, if they're in their 80s, they probably don't have a lot on auto pay. That's a newer concept for that age group. And so by going through and doing that, that certainly makes life a little bit easier as a caregiver, because you know that all of those bills are then getting paid automatically. And other things to consider involve what to do in terms of the assets and things like that. So we've got more on this particular concept, but we will cover that after these messages as we continue on here on Dollars and Cents with a conversation about some of the things that you as a caregiver need to be aware of, need to do in order to make sure that you're able to function properly in that role. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So on the program, we're talking a little bit about some of the things that you need to be aware of as a caregiver for a loved one. More and more Americans find themselves in that position. So we're kind of going through some of the major points that were included in a recent AARP article, and certainly some good stuff. Before the break, we were talking about a couple of those items involving familiarizing yourself or making sure that you've got the proper legal documents in place, because if you're going to act on behalf of somebody else, you need to have a legal document in order to be able to do that as well. And then we were continuing the conversation with some of the ways in which you might be able to protect or connect with that individual person's finances, whether that is figuring out how to log into their accounts, setting up things like auto pay to make life easier, as well as making sure that you take advantage of designating beneficiaries when that is available to do so. Because what that does is that means then that when that person passes, then that particular asset is going to go automatically to the named beneficiaries without having to go through probate. So pretty important to make sure that you're taking advantage of that. Another suggestion is to freeze their credit, right? If I'm, in my 80s and in assisted living, unlikely that I'm going to need to borrow money for a car or a house or something like that. But because they have a credit profile, then that could certainly make them susceptible to use by scammers and fraudsters and things like that. So putting a credit free is actually a very good suggestion in terms of putting that on that individual that is unlikely that they're going to need credit. And then, of course, making sure that you're organized on all this stuff, right? That's pretty important as well. So those are kind of the first two things in why I have some of the things to be focused on as a caregiver. We've still got three more, so stay with us here on this segment of Dollars and Cents, where we help you make sense out of all of life decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast on the World Wide Web. Make sure you check us out on our website at nelsonfinancialplanning.com. While there, if you're interested in taking advantage of our holiday gift to you, make sure you request a free copy of our book, Next Gen Dollars and Cents. Or if you're interested in getting a second opinion or just a first opinion on the state of your finances and potential retirement or existing retirement, as the case may be, make sure you fill out the Contact Us form on the website. All of our consultations are absolutely free of charge. And of course, because we believe in actually helping people, we don't have any account minimum requirements at Nelson Financial Planning. We believe in meeting you where you are, wherever that might be on your financial journey. My name, of course, is Joel Garris, certified financial planner and certified financial fiduciary at Nelson Financial Planning. So as the list continues in terms of some of these items that you as a caregiver need to be aware of, next up would be perhaps maybe the hardest one, and that is to have a conversation with your loved one and the extended family. And this is where it can get tricky very, very quickly. But it's certainly important to talk about it. Don't assume that certain people are going to do certain things. Most of the time in the office, we hear stories where a lot of the care falls to one individual. And that certainly is the case for me personally as well. with my mom, and so that can be another layer of emotion in the family dynamics, if you will. So it's important to have those conversations early on as best as possible and discuss roles and responsibilities and what everybody says they're going to do and what everybody is going to do, and that they actually do it. And certainly, it's particularly important to get other members of the family involved and make sure that they are committing to it. Otherwise, you may find that it all falls in your court. Next up to be aware of would be, look, there's a lot going on with this. We've talked a lot about different types of things that you can be, that you're going to need to do. Some of which is going to require professional assistance and maybe even a personal support team as well. So beyond family, friends, community members, things like that to provide emotional support, there's also some professionals you probably want to get in the circle of knowledge as a caregiver. A lawyer, we talked about the legal documents that are necessary to act on behalf of somebody else. Only a lawyer really is the certified individual that, or licensed individual that can kind of prepare those documents. Yeah, you can go online and do it there, but in these particular cases, we always recommend using a Florida attorney or an attorney in whatever state it is that you're sitting in right now as you listen to the program. An accountant, always a good idea. A financial planner, those are certainly important. The other category, and this is something somebody that we use with my mom, is that a medical care manager. And what that is sort of a newer concept, but it's very helpful because I don't know about you, but when you last went to a doctor's appointment, it wasn't exactly an in and out in an hour kind of thing. It's, by the time you pick the person up, by the time you go, by the time you get the person, you're talking about 3 or 4 hour proposition, right? So that can be tricky if you are still working full time. So a medical care manager can help coordinate that and get that individual to these appointments. And so, not exactly a cheap service by any stretch of the imagination, but certainly a valuable one to the extent that you are a caregiver that is also working as well. That's when things can get very, very tricky. And then lastly, make sure that all the critical documents are in a single place and immediately available, right? Things like birth certificates, things like passports, things like investment account statements, or maybe deeds to property. All of those things are important to know where they are, particularly in order to be of help to you. So those are sort of the 5 key takeaways for family caregivers that we think are pretty important. A lot of that information we discussed came courtesy of an AARP article as well. But certainly to know the applicable legal documents, that's first. Number 2, consider how to protect and connect with that loved one's finances. Number 3, take an opportunity to sort of talk with the entire family and the loved one as well when it comes to making sure that caregiving responsibilities are understood and divided appropriately. Number 4, get professional help and guidance along the way. Obviously, that's very important. And then make sure you know where the crucial or critical information is. All very important stuff if you find yourself in the role of being a caregiver. What you may also be finding yourself in the role of, given that the average American changes jobs, I think it's like 11 times per year during the course of their career, you may find more and more where you've got money in a employer retirement plan that is, in fact, an employer that you no longer work for. And what's interesting is that more and more companies are doing things to make sure that you keep your 401k or dollars in whatever their qualified retirement plan is with them after you leave or after you retire. And so there's some important considerations there in terms of why that push is on and how companies are dealing with that to encourage you to kind of leave that money with them. And the reality is what you should be doing instead. So we're going to dig into that topic in our next segment here on Dollars and Cents. So stay tuned with us through the break. And of course, this is Dollars and Cents, where we help you make sense out of all of life's life decisions involving your dollars. Make sure you check us out on our website at Nelson Financial Planning to learn a little bit more about what we do during regular hours when we're not on air with the radio program and podcast. My name is Joel Garris, certified financial planner and certified financial fiduciary with Nelson Financial Planning. And we'll continue the conversation after these messages here on Dollars and Cents. So we're talking about this concept that involves more and more companies really trying to encourage you to keep your old 401k or 403b monies with them even after you've left their employment, or maybe even after you've even retired. And we understand sort of where that comes from, just from a human being perspective, right? It's just easy, right, to leave money where it is. We see that all the time, even in cases where it may be costing you money in terms of costs or expenses or investment performance. Inertia is a pretty powerful force, particularly when it comes to your money. And in this particular case, according to the folks at USA Today, your former employer also has a major reason as well to want you to leave that money behind. And that is, simply put, it is better for them. It saves them money. And here's how. Because the more assets that are in a particular employer-sponsored plan, the lower the potential amount of fees, because with more assets, then you achieve more economies of scale. And that ultimately costs that employer less if there's more money in the plan, because if there's more assets, then you have more purchasing power and more negotiating power, all of those kinds of things. So let's not forget the chief reason why you're seeing this uptrend, at least according to USA Today, in your employer trying to encourage people to leave that money behind, doesn't have anything to do with you. It has everything to do with the cost to the employer itself. The larger the plan, the lower those costs are. So it's really more of a benefit to the prior employer, if you will, not necessarily to you. Now, employers have certainly done a number of things of late to try and pull out the red carpet to encourage people to stay by really addressing two of the biggest concerns that retirees have. Somewhere around 6 in 10 retirees these days are concerned about inflation. Frankly, I think it's probably more than 6 in 10 that are concerned about inflation. And then also next to inflation would be market volatility, and that's probably more than 6 out of 10 as well. But what that does is, particularly that market volatility, it's driving people to become more conservative in their investment approach as a result. So to counter this and deal with these concerns directly, what you're seeing in employer plans is that more and more you're seeing broader bond offerings. Bonds obviously are sort of a counter to stocks, where bonds have lower returns historically over time, but have lower volatility. So to try and deal with that volatility question, they're expanding their more bond or fixed income options inside the plans. And what they're also doing is adjusting sort of the inflation protection offerings as well, in the hopes of sort of addressing these anxieties that most retirees have in order to sort of induce folks to leave the money behind. But there really are a sort of a host of considerations that are frankly more material to you that you need to be thinking about, right? It's sort of immaterial to you how much your former employer pays to maintain their qualified retirement plan, right? That's immaterial. That's their problem. That's not yours. It's sort of also immaterial to you to have more options in terms of the investment options, just to address sort of emotional responses to inflation and volatility. So there's a host of other things to really be thinking about as you think about this decision of whether to leave the money behind or whether to roll it over to an individual retirement account or similar vehicle, because then that way you would have full control over it. It would no longer be part of the employer plan. Chief among them in terms of the list of considerations is, of course, cost, right? You'd always be considered what the cost is anytime you're doing business with anybody for anything. Make sure you understand, though, all of those potential costs, because too often, particularly in the financial services industry, there's this notion of splitting these costs out, and very few people realize that you got to add them together to get the true total cost. So what we're talking about is that there is a difference in cost of the investments and cost of the advice. And you got to make sure you're combining those two to get an accurate reflection of that total cost number, because certainly it's important to know that investment expense plus advisory expense can add up pretty good. And anytime those expenses are higher than really kind of what they should be, then that's going to be a drag on your return, which basically is a nice way of saying you're going to have less money. So that's number one, and always usually part of the issues. Number two, right on the heels of that, is actually the investment options, right? What are the investments available? How have they performed? Because after all, performance, that's kind of the crucial concept when it comes to your investments. And even though employer plans might be adding more in terms of options, they have a tendency to be very cookie cutter, right? A lot of target date stuff or sort of blind index options. Rolling over that account allows for much broader selection of options, and certainly always does in comparison to an employer plan, because an employer plan is always going to have sort of a limited Denny's menu, if you will, of options. You also have a little bit better access to the money. A lot of employer plans will make you do paperwork or restrict your ability to take money as you might specifically want from a specific fund. They may force you to take it proportionally across all of the different funds, when you may want to just take it out of like one fund that's done really, really well, and to focus that withdrawal on a particular holding. So certainly the access to money when it's outside of an employer plan certainly broadens. Control, I guess, would be another one on the list, right? If it's in your employer plan, then ultimately it's your employer who's making the decisions as to what's going on from a strategy perspective and who ultimately the provider is that is being used inside that plan. And they can make changes at any point in time, right? I mean, we talked about the biggest reason why employers want you to leave your money behind is the more money that is in the plan, the lower the cost for them. And so what we also see is that employers constantly changing providers for their retirement plans in that effort to seek the lowest possible cost. So just be aware that if you leave that sort of world and you go into your own individual retirement account, obviously you have more control over that. And that is important because when you think about some of these statistics, and we've shared this one before on the program, there's about 24 million forgotten 401ks holding what is estimated to be almost $1.4 trillion. Hope one of those isn't yours, but it could very well be one of your own accounts. So by ultimately moving that money out of that ex-employer plan when it becomes an ex-employer, you can kind of keep track of that. You're not going to lose track of that. And when you look at these statistics, there's certainly a lot of folks that have lost track of that. What an individual retirement account also does is it gives greater flexibility for your beneficiaries. And this has to deal with the rules involving how beneficiaries are required to take money out of retirement accounts. It used to be that there was a lot more flexibility. Nowadays, it's a 10-year rule. So being in an individual retirement account gives you a lot more flexibility. A lot of employer plans have much greater restrictions on kind of what you have as options from a beneficiary perspective. And then lastly, and maybe this one is probably the most self-serving, let's not forget the role of professional advice and guidance, right? Not coming from a website, not coming from an 800 number, clearly to help you understand what is going on with your investments, your retirement plan, your overall financial picture. I guess the reality is just because you got a set of steak knives doesn't make you a butcher. Also, just because you have investments, it doesn't make you a fiduciary-based financial planner that understands investments and taxes. So with that thought, we will wrap it on up and get on out of here as we conclude this week's edition of Dollars and Cents. We want to thank you all for listening to the program. For those of you who heard it live, we thank you for your continued listening to terrestrial radio. For those of you on the podcast or YouTube side of things, well, that is fantastic. And certainly that is the growing audience of which we seek. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. Make sure you take the time to check out our website this week at nelsonfinancialplanning.com.